Good afternoon, everyone, and happy Halloween. I'm Stacy Scott, and I'm here with Graham Wickham, President and CEO of Wickham Financial and Insurance Services, and we're here with you today for our weekly wrap-up. Graham, were there tricks or treats in the market last week?
Well, unfortunately, we had some tricks last week. We really just saw the equity markets continue to struggle. I think we're in the third, fourth week of this, if not longer. Just struggling under strong economic data and what that might force the Fed to have to do in terms of interest rates. So we saw the S&P, the NASDAQ, the Russell down 2.5+%. We saw the S&P actually drawing pretty close from into what's called a technical trend reversal. That means if it breaks it and it's confirmed that it's broken, it could go lower. I'm not trying to spook anyone, but it just could mean some more volatility. Again, don't do your investing around that necessarily, but it's just something that we try to be a little more mindful of, at least in the very, very short run. So we did see 10 of the 11 S&P sectors losing ground, led by communication sliding just over 5%. We had some little earnings disappointments from maybe Alphabet and Meta, some large companies. If we look over to the commodities like the energy side, we saw that come down about 6+%. Oil slid about 3.5%. So we did see some earnings from Chevron on that side miss some expectations. If we look over at Bitcoin and the cryptocurrency area, boy, that just surged. I mean, we really saw that move up over 13+% last week alone. From a U.S. Treasury yields, we did see them ease slightly, even as we did see third quarter GDP grow a whopping 4.9%. Now, that was off pretty strong consumer spending numbers, not completely unexpected. And we do know, or we do feel, because we're seeing some of the data coming through right now, at least the economists are, that we're seeing that the consumer is starting to pull back a little bit, being more mindful of the spend. So to expect that type of high GDP numbers going forward just completely is not expected. So we are seeing and expecting those numbers to come down much more in that 2+ range going forward. If we look at some economic data, we saw the U.S. Durable goods orders jump about 4.5% in September. That was the largest gain since July of 20. If we look at manufacturing, pulled out of a 5-week contraction at the same time. And we did see some new home sales rise about 12.3% month over month as buyers were maybe unable to find inventory in the resale market. So that was the new home. We go overseas and we think internationally, you saw the European Central Bank really pausing on the hike campaigns, maybe feeling that maybe they've done enough or they want to sit and wait and see. We saw the Germany contraction for a 4th straight month in their economic growth. Could be signaling that they're already in or entering a recession. We look at the Bank of Canada also kept their rates pretty steady at this point. And we go over to Japan, we saw the core CPI rise about 2.7%. That was a bit above their expectations of about 2.5.
Okay, well, Graham, is there any market seasonality that investors should be mindful of?
Yeah, we do. As we mentioned before, August to the first parts of October traditionally are just really challenging times in the market. So on the flip side of that, when are the good times in the market? At least, looking at the past. If we look at November, December, and April, traditionally the best times in the market. So we're entering that now, right? There's a lot of seasonal factors on the reason why that would be so. But if you look at it, this fourth quarter period is up since 1950, about 80% of the time. And if you look at November, it averages an increase of about 1.9%. And for December and April, somewhere around 1.7, 1.5% during those periods.
Okay, well, what kind of opportunities does that present?
Well, if you're underweight, listen, we're coming into the quarter really down 10+% for the S&P and the Nasdaq, entering some correction territories. Certainly the Dow hasn't really done anything. In the small caps, mid caps, not to mention international, most sectors have just really underperformed and in corrections or been in corrections. So this might be an opportunity, if you felt like you were underweight, to start to overweight. Now, again, it's not a crystal ball. It's not a guarantee that this time is going to be the same as the past, but those are pretty strong odds if you feel like you are underweight and you need to get some money to work for you in the markets. Also think about this, we're entering tax loss selling. So if we look at the sides of the market that really underperformed, and that could be bonds, that's most things out there, right? Outside of tech or the top 7 or 10 stocks in the S&P. If they're down or they've really underperformed for the year, you might people coming out there and selling, institutions, investors selling to take tax losses to offset gains. That might be an opportunity in weakness to add to those sectors.
Okay. Well, thanks so much, Graham. And thank you to our viewers for joining us today. We hope you have a great afternoon, and we hope you have a very happy Halloween. Take care.